We continue to search for yield in today's low interest rate environment. The problem is most Canadians in their need for yield are overweight one of the most overvalued assets, corporate and government bonds. And in the search for higher yields, we find ourselves reaching deeper and deeper into lower grade fixed income products. All of this comes with significant credit and interest rate risks. Now at the same time, all we really want is the long-term returns that the equity markets provide, but we often don't like the volatility that is associated with it. So we've established the Purpose Premium Yield Fund, which is designed to provide you a great way to achieve long-term returns similar to the equity markets, but with less volatility and risk of loss. At the same time, its goal is to provide a high level of steady income without taking on credit or interest rate risk. It's a great alternative source of income for your portfolios, and it'll allow you to generate the income and returns you're searching for while allowing you to reduce your ownership of bonds and equities in the overall portfolio. The fund is aiming to generate an attractive yield of 7%, along with attractive net asset value growth on top of this. But we're going to do this with lower volatility relative to the equity markets. So how do we achieve this, and what is the strategy behind the fund? First, the primary strategy of the fund is to mine the volatility from a portfolio of high quality and fundamentally strongs that we really like. We would never sell an option on stock unless we truly like the company fundamentally, and it's a stock that we would be happy to own outright. We select these stocks using a set of fundamental rules, starting from a universe of the largest companies in the US and Canada. We then filter in the companies based on three factors: quality measures, relative valuation measures, and sentiment measures. Now the quality measures look at the company's underlying fundamental strength. Is the company doing the things that good companies do? Is it fundamentally trending positively or negatively? Now examples of measures we look at are, is its return on assets improving? Is its profits increasing? Is its debt declining? Or is its asset turnover increasing? We then look at companies that look attractive based on their relative valuations compared to their peers. How is the stock valued based on measures of cash flow, EBITDA, current and future revenues, and dividends? We want the cheapest businesses within each respective industry. And now finally, we look at sentiment and high conviction ideas that are held by some of the greatest money managers around the world. These are names including Warren Buffett, Carl Icahn, Eric Mindick, Leon Cooperman, and others that we deem to be the best at what they do. The result is a final list of stocks that we will make a decision on whether we want to own the stock outright, or if we want to write a put option to buy it at a cheaper price in the future, or just buy and write a covered call against. This option overlay decision will be made using a number of macro and micro factors, including current volatility of the broad markets, the attractiveness of the available option premiums on the stocks that we've looked at, the liquidity of the options, and the maturity of the options available relative to the premium. Now 85 to 90% of the time, the fund will use a cash covered put option strategy, whereby rather than buy the stock we want to own right then, we'll write a put option against the stock, generally 10% out of the money, which is fully covered with the cash we have on hand in the fund. We collect an attractive premium from writing of the put option, and then at the expiration date of the option, one of two events will occur. If the stock price stays above the exercise price, we have just collected our premium, and we would then write another put option on the same stock or another stock that we deem more attractive at that time. If the stock was to fall below the exercise price and we are put into the stock, first, remember it's a company that we are happy to own regardless, and we are put in at a price that is 10% cheaper than when we wrote the option in the first place. We would now likely decide to either write a call option out of the money on that stock to collect an option premium again, but we would also weigh this against holding the stock uncovered if we felt it has the potential for greater price appreciation, or if we really didn't feel comfortable with the stock, we might sell it outright if the fundamentals didn't make us comfortable to own it. Now this process will be repeated continuously on the different stocks we have fundamentally selected over the life of the fund. So again, we select stocks we like, we write cash covered put options on these stocks out of the money. If the put option doesn't get exercised, we write a put again and continue to collect premiums. If the stock falls and the put option gets exercised, we'll likely write a call option on that stock, collect a premium, and continue the process. This is what we call mining volatility. So what should you expect in terms of performance behavior of the fund relative to the broader markets? Well, the result of this strategy is to provide an equity-like return with much lower risk relative to the broader equity markets. And the fund will pay the returns primarily as a stream of income in the form of capital gains and dividends. And we would anticipate also having an attractive level of net asset value growth on top of the distributions that we pay out. Now, in equity markets that are downtrending, flat, or modestly increasing, we would expect the premium yield fund to outperform the general equity markets. But in very bullish markets where we have strong double-digit-like returns, we would expect the fund to underperform the markets. This is a strategy that is not designed to provide 15 to 20% like returns. Rather, our target is to provide a total return of 7 to 10% per annum. Now, like all purpose funds, we believe in optimizing every element of the experience that you as an investor have with us. So the Premium Yield Fund has one tax-efficient income stream targeting a 7% yield paid monthly. This income will be paid primarily as capital gains and returns of capital. 2, we offer both ETF and mutual fund series, allowing you to buy the fund how you feel most comfortable. 3, it will provide daily transparency of every element of the investment strategy and its holdings. This is something that's important to us at Purpose, and we use this across every one of our funds. And finally, 4, the fund is packaged with a low management fee of 0.6%. This is a very attractive fee level for both the active investment strategy plus the tax-efficient return streams that we'll be providing. Now, in addition, remember the fund is structured using Purpose's innovative corporate class. So you can switch amongst this and other funds within the Purpose Fund Corp without triggering a capital gain. We hope you enjoy the Purpose Premium Yield Fund, and remember, always invest with purpose.